Something unusual is happening in Taiwan. While the world watches stock markets and crypto, one quiet island is moving billions into something ancient. Gold, not paper gold, not futures contracts, actual physical metal, and they are not alone. Central banks across Asia are doing the same thing, silently, urgently. But here is what almost nobody is talking about. There is a supply problem, a serious one. And in the middle of this crisis, one small company in British Columbia might hold a solution that could change everything. Stay with us, because what you're about to discover could rewrite your understanding of what is coming. Welcome to John AG. If this is your first time here, think of this channel as your weekly strategy session. The kind of conversation you would have over coffee with someone who has been watching markets for decades. No hype, no noise, just clear analysis. Now, a small request from an old habit of mine. I have learned over the years that the best conversations happen when people actually show up. So if you find value in what we discuss here, hit that subscribe button. Think of it like pulling up a chair to the table. It tells me you're serious about understanding what is really happening beneath the headlines. And one more thing, drop a comment below and tell us where you're watching from. Are you in New York, London, Singapore, Lagos? It helps us understand who is paying attention and where the smart money is starting to ask the right questions. All right, let us begin. There's a pattern emerging in global markets that most analysts are missing. It is not loud, it is not making headlines, but it is significant. Taiwan is buying gold, a lot of it. According to official customs data reviewed in late 2024, Taiwan imported over 90 tons of gold in the first 3 quarters of the year. That is nearly double the volume from the same period in 2023. For context, Taiwan is a small island economy. Its population is just over 23 million people. Yet its gold appetite is now rivaling nations 5 times its size. This is not a cultural trend. This is not about jewelry or tradition. This is strategic accumulation, and Taiwan is not acting alone. Across Asia, central banks have been on a buying spree that started quietly in 2022 and accelerated sharply through 2023 and 2024. The World Gold Council reported that global central bank purchases hit record levels in 2022 at over 1,000 tons. In 2023, that figure remained elevated at over 1,000 tons again. Through 2024, the pace continued without signs of slowing. China, India, Singapore, Thailand, the Philippines, all buying, all increasing reserves, all moving away from dollar-denominated assets and into physical metal. But why Taiwan specifically matters requires understanding something deeper. Taiwan sits at the center of the most sensitive geopolitical flashpoint on the planet. The Taiwan Strait is not just a geographic feature, it is the choke point for global semiconductor supply chains. Over 60% of the world's advanced chips are manufactured on this island. If tensions escalate, the economic consequences would be catastrophic. So when Taiwanese institutions and wealthy families begin converting liquid assets into gold, it sends a signal. It says they are preparing for scenarios where currency stability cannot be guaranteed, where capital controls might be imposed, where physical assets become the only reliable store of value. This is not speculation, this is observable behavior. Now, contrast this with what is happening in Western markets. In the United States and Europe, gold is still largely treated as a portfolio hedge. It trades on COMEX, it exists in ETFs, it sits in allocated accounts, but very little of it moves physically. The average investor never touches a bar, never sees a coin. The entire system runs on paper promises backed by fractional reserves. But in Asia, the game is different. Physical delivery matters. Premiums over spot price exist because buyers want metal in hand, not contracts. In cities like Hong Kong, Singapore, and Taipei, vault operators are expanding capacity. Dealers are reporting backlogs. Refineries are running at maximum output. The divergence is stark. Western markets price gold based on derivatives and sentiment. Eastern markets price gold based on scarcity and possession. And here is where the story gets interesting, because while demand is accelerating in the East, supply is collapsing in the West. Global gold discovery rates peaked in the 1990s. Since then, the number of major new deposits found each year has been in structural decline. The easy gold has been found. What remains is deeper, lower grade, harder to extract, and located in increasingly difficult jurisdictions. The major mining companies know this. They have been saying it quietly in earnings calls for years. Reserve replacement rates are falling. Existing mines are aging. New projects are stuck in permitting hell. Meanwhile, it now takes an average of 15 to 17 years to move from discovery to production. 15 years. That means any new supply coming online today was found during the financial crisis era. So the math is simple. Demand is rising. Supply is falling. The time required to fix the supply problem is measured in decades, not years. This is not a temporary imbalance. This is a structural shift, and it creates a very specific kind of opportunity, not in the gold itself, but in the companies that that control undeveloped deposits in jurisdictions where production is still possible. That is where Scotty Resources enters the picture. But before we get there, we need to understand why location matters more than ever. There's a truth about natural resources that Wall Street prefers not to discuss. You cannot print gold. You cannot manufacture it in a factory. You cannot code it into existence. You cannot negotiate it into being. You have to find it, dig it, process it. And that takes time, capital, and political permission. Right now, the global mining industry is facing all three constraints simultaneously. Let us start with time. In 1990, the average timeline from discovery to first production for a major gold deposit was roughly 7 years. That included exploration, feasibility studies, permitting, construction, and commissioning. By 2010, that timeline had stretched to 12 years. Today, it sits closer to 17 years. In some jurisdictions, it exceeds 20. Why? Complexity has increased at every level. Environmental assessments are longer. Indigenous consultation processes are more rigorous. Financing windows are narrower. Engineering standards are stricter. And political risk has multiplied. A company can spend a decade proving a world-class deposit exists and still get blocked at the permitting stage by a single regulatory change or election outcome. This is not theory. This is documented reality. Several billion-dollar projects in South America, Africa, and even parts of Europe have been effectively killed after years of development because governments changed, policies shifted, or social opposition mobilized. Investors lost fortunes, deposits remain in the ground, and the supply deficit widens. Now add the capital problem. Gold exploration is expensive. Drilling costs money, metallurgical testing costs money, feasibility studies cost money, and none of it generates revenue until production begins, which, as we just established, might be 2 decades away. So where does that capital come from? In a bull market, it flows freely. Junior explorers can raise funds, drill programs expand, discovery rates climb. But in neutral or bear markets, capital evaporates. Exploration budgets get slashed, drill rigs sit idle, geologists get laid off. And here's the problem. From roughly 2013 to 2020, the gold sector was in a prolonged downturn. Prices were stagnant. Sentiment was terrible. Exploration spending collapsed. That means the discoveries that should have been made during that period were not made. That means the mines that should be coming online in the late 2020s and early 2030s do not exist. There is a gap, a missing generation of projects, and that gap is about to become very visible. The third constraint is political permission. And this is where jurisdictional analysis becomes critical. Not all mining jurisdictions are equal. Some countries have stable legal frameworks, transparent permitting processes, and respect for property rights. Others do not. In certain African nations, license terms can be rewritten retroactively. In parts of South America, resource nationalism has led to forced renegotiations, windfall taxes, and outright expropriation. Even in developed markets, political risk varies wildly. Australia has solid infrastructure but faces rising labor costs and environmental opposition. The United States has strong rule of law but incredibly slow federal permitting, especially on public lands. Europe has advanced economies but nearly insurmountable social resistance to new mining projects. Then there is Canada, specifically British Columbia. Canada ranks consistently in the top tier of global mining jurisdictions. It has clear title systems, established regulatory processes, legal certainty, and a mining culture that dates back over a century. British Columbia, in particular, has geology that is world-class. The Golden Triangle, located in the northwest corner of the province, is one of the most prolific mineralized regions on Earth. It has produced some of the largest and highest grade deposits ever discovered in North America. But here's the paradox. Despite its geological wealth, the Golden Triangle remains vastly underexplored compared to other major mining districts. Why? Infrastructure. Or, more accurately, the historical lack of it. For decades, the region was too remote. No roads, no power, no processing facilities. The cost of getting equipment in and or out was prohibitive, but that has been changing. Over the past 15 years, new roads have been built, power lines have been extended, port facilities have been upgraded. What was once an inaccessible wilderness is now becoming a viable development corridor. And that creates a rare situation. You have world-class geology in a Tier 1 jurisdiction with improving infrastructure at a time when global supply is constrained and demand is accelerating. This is not speculation. This is strategic positioning. The companies that control prospective ground in this region are sitting on optionality that did not exist a decade ago. But not all projects are created equal. Some are in the right district but lack scale. Others have size but are too remote. Some have good drill results but poor metallurgy. Others have strong technical teams but weak balance sheets. The market is ruthless about differentiation. And that brings us to a specific case study, a company called Scotty Resources. Not because it is being promoted, Not because it has the biggest marketing budget or the loudest investor relations team, but because when you apply institutional due diligence to its technical position, management structure, and strategic timing, a pattern emerges. A pattern that explains why certain projects attract serious capital while others remain ignored. Let us examine what makes the difference. Most exploration stories sound the same. Big claims, promising geology, exciting potential. But when institutional capital evaluates a junior mining company, it does not listen to the story. It looks at the data, and the data tells a very different kind of truth. Scotty Resources is not the largest exploration company in British Columbia. It is not the most well-known. It does not have the biggest market capitalization or the most aggressive promotional campaign. But it has something else. It has positioning. Let us be specific. Scotty Resources controls a property package in the Golden Triangle that sits in a geological corridor with a proven track record. This is not virgin territory. This is not a speculative land grab in the middle of nowhere. This is ground that lies near some of the most significant gold and copper discoveries made in the past 2 decades. Proximity matters in mining, not because deposits cluster randomly, but because they form within large-scale geological systems. When you find one major deposit, the odds of finding another nearby increase dramatically. Geologists call these mineral belts or metallogenic provinces. Wall Street calls them districts. Either way, the principle is the same. If you are exploring in a proven district, your probability of success is measurably higher than if you are drilling random targets in isolated regions. Scotty's land position places it inside one of these districts. Now, let us talk about the technical work that has already been done. Historical drilling on the property has returned results that are worth paying attention to. Not hype-worthy intersections taken out of context, but consistent mineralization across multiple drill holes that suggests a coherent system. When a geologist reviews drill data, they are looking for patterns. Is the mineralization erratic or continuous? Is it shallow or deep? Is it narrow or broad? Does it correlate across holes or appear random? The historical data from Scotty's project shows continuity. That is significant. Continuity means the mineralization is not just a lucky hit. It suggests structure. It suggests a feeder system. It suggests the potential for scale. And scale is what separates an interesting anomaly from an economically viable deposit. But geology alone is not enough. You also need metallurgy. Some gold deposits are simple to process. The gold is free milling, meaning it can be extracted using conventional methods with high recovery rates and low costs. Other deposits are metallurgically complex. The gold is locked in sulfides or associated with penalty elements like arsenic or antimony. Processing becomes expensive. Recovery rates drop. Economics deteriorate. Early metallurgical test work on Scotty's mineralization indicates favorable characteristics. The gold appears to be amenable to standard processing methods. That keeps capital costs down and operating margins up. Again, this is not promotional language. This is technical evaluation. Next, consider infrastructure. A world-class deposit in the middle of a desert with no road access, no water, and no power is worth far less than a decent deposit near existing infrastructure. Scotty's property benefits from relatively close proximity to established transportation routes. It is not sitting on a highway, but it is not stranded either. The cost of building access infrastructure is manageable, not prohibitive. This matters enormously when it comes time to finance development. Lenders and strategic partners evaluate infrastructure risk carefully. If a project requires hundreds of millions of dollars in roads, power lines, and ports before a single ounce of gold can be produced, financing becomes much harder. But if basic infrastructure already exists or can be extended economically, the project becomes financeable. Scotty sits in the viable category. Now let us examine management. In junior exploration, management quality is often more important than the asset itself. Why? Because even the best deposit can be destroyed by poor capital allocation, dilutive financing, or strategic missteps. Scotty's leadership team has a track record in the mining sector. They have experience taking projects through exploration cycles. They understand permitting. They know how to manage cash. They have relationships with institutional investors and potential strategic partners. This is not a team of first-time promoters running a stock promotion scheme. This is a group of professionals with technical credibility. That distinction matters. Institutional investors will not touch a company run by promoters, but they will take meetings with experienced operators who understand the development pathway. And that brings us to the balance sheet. A company can have the best project in the world, but if it runs out of cash before completing the next phase of drilling, it becomes worthless. Scotty has maintained a relatively disciplined approach to capital management. It has raised funds when markets were favorable. It has controlled burn rate during slower periods. It has avoided reckless dilution. As of the most recent financial disclosures, the company has sufficient treasury to fund its planned exploration programs without immediate need for emergency financing. That gives it runway, and runway gives management the ability to be strategic rather than desperate. Desperate companies make bad deals. They sell assets cheap, They accept punitive financing terms. They lose negotiating power. Companies with runway can wait for better terms. They can advance projects at optimal pace. They can attract strategic partners from a position of strength. Finally, there's the market context. Timing matters as much as fundamentals. A great project launched into a terrible market often fails. A decent project launched into a rising market often succeeds. Right now, the macro setup is shifting in favor of gold equities, particularly exploration and development stage companies. Physical gold demand is accelerating in Asia, as discussed in Part 1. Supply constraints are tightening, as discussed in Part 2. And investors are beginning to recognize that the next wave of production growth will not come from the major producers, but from projects currently held by junior explorers that eventually get acquired or partnered. This is where Scotty becomes interesting not as a promotional story, but as a case study in strategic positioning. It has the geology, it has the jurisdiction, it has the infrastructure access, it has competent management, it has balance sheet runway, and it exists at a moment when the market is starting to ask the right question. Not which stocks are moving, but which projects can actually get built. That question changes everything. And the answer is starting to separate real opportunities from noise. There are moments in markets when separate trends collide, when what was theoretical becomes practical, when what was ignored becomes urgent. We are approaching one of those moments now. On one side, you have accelerating physical demand from Asia. Taiwan, China, Singapore, and central banks across the developing world are converting financial assets into gold at a pace not seen in decades. This is not speculation. This is documented behavior, customs data, central bank reports, refinery throughput numbers. The demand is real, and it is growing. On the other side, you have a supply system that is structurally broken. Discovery rates are down, development timelines are stretched, permitting is slower, political risk is higher, capital is selective. The major mining companies are not replacing reserves fast enough, existing mines are depleting, and the pipeline of new projects is thin. This is not a temporary disruption. This is a long-term structural imbalance. And when demand rises while supply falls, price is the only mechanism that can restore equilibrium. But here is what most people miss. The price of gold itself is only part of the story. The bigger opportunity lies in the equity market for companies that control way-developed deposits in viable jurisdictions. Why? Because gold equities provide leverage to the underlying metal price. A 10% move in gold can translate into a 50 or 100% move in a well-positioned explorer or developer. But only if the project is real, only if the jurisdiction is credible, only if the company can actually advance the asset toward production. That is where differentiation matters. Right now, there are hundreds of junior mining companies listed on exchanges in Canada, Australia, and elsewhere. Most will fail. Most are burning cash on marginal projects in difficult locations with inexperienced teams, but a small subset will succeed. And that subset shares common characteristics. They are in Tier 1 jurisdictions. They have technical teams with track records. They control prospective ground in proven districts. They have balance sheet discipline. And they are advancing their projects methodically, not recklessly. Scotty Resources fits that profile. It is not the only company that does, but it is one of the clearer examples. And when institutional capital begins rotating back into the gold exploration space, which appears to be happening now based on fund flow data and conference attendance trends, these are the types of names that get attention first. Not the loudest, not the most promoted, but the most credible. Now, let us address risk, because no investment thesis is complete without understanding what could go wrong. First, gold prices could fall. If central banks reverse course and begin selling reserves, or if the Federal Reserve pivots aggressively back to rate cuts and restores confidence in fiat currencies, demand for gold could weaken. That would undermine the entire macro thesis. Second, geopolitical tensions could ease. If tensions around Taiwan stabilize, if trade relationships normalize, if currency stability returns, the urgency driving physical accumulation could dissipate. Possible, but current trends suggest the opposite. Third, a major new discovery could flood the market with supply. If a company announces a world-class deposit with easy metallurgy in a great jurisdiction, it could temporarily reduce scarcity premium. But given the exploration downturn of the past decade, this seems unlikely in the near term. Fourth, Scotty itself could stumble. Management could make poor decisions. Drilling could disappoint. Financing could fail. Company-specific risk always exists. That is why due diligence matters. That is why position sizing matters. But from a portfolio construction perspective, the question is not whether Scotty specifically succeeds. The question is whether the broader thesis holds. And if the thesis holds, that Asian physical demand is structural, that supply constraints are real, that development timelines are long, and that viable projects in good jurisdictions are scarce, then exposure to this space makes strategic sense. Scotty is one way to express that exposure. There are others. But what separates useful analysis from noise is understanding why certain projects matter and others do not. It comes down to three things: geology, jurisdiction, timing. Scotty has favorable geology in a proven district. It operates in a Tier 1 jurisdiction with improving infrastructure. And it exists at a moment when macro conditions are aligning in favor of supply-side scarcity. That does not guarantee success, but it stacks probabilities. And in resource investing, stacking probabilities is the entire game. Now, what should a business-minded audience take away from this analysis? First, pay attention to what actions reveal, not what headlines claim. When central banks buy gold, they are not speculating. They are protecting systemic stability. When Taiwan accelerates imports, it is not chasing momentum. It is hedging risk. These are strategic moves by serious institutions. They deserve serious attention. Second, understand that supply and natural resources cannot be conjured on demand. You cannot solve a gold supply deficit with monetary policy or financial engineering. You need mines, and mines take decades to build. That time lag creates opportunity for those who position early. Third, recognize that jurisdictional quality is a moat. In a world where political risk is rising, operating in stable, transparent, rule of law environments is a competitive advantage that compounds over time. Canada, and specifically British Columbia, offers that advantage. Fourth, apply institutional grade due diligence to any investment consideration. Do not chase stories, evaluate data, assess management, understand balance sheets, verify claims. If a company cannot withstand scrutiny, it does not belong in a serious portfolio. And finally, monitor the right indicators. Watch Asian physical premiums. Track central bank reserve reports. Follow permitting timelines in key jurisdictions. Observe fund flows into gold equities. These are the signals that tell you whether the thesis is strengthening or weakening. Right now, those signals are pointing in one direction: toward tightening supply, toward rising physical demand, toward a market that is slowly waking up to a structural imbalance that will take years to resolve. Scotty Resources is not the story. It is a symptom of the story. The real story is much larger. It is about what happens when the world is second largest economy and its strategic neighbors decide that financial assets are not enough, when they decide they need tangible reserves, when they decide that gold is not a relic, but insurance. And when that shift accelerates, the companies that control viable deposits in safe jurisdictions will not need to promote themselves. The market will find them. The only question is whether you recognize the signal before the consensus does. Because once everyone agrees the story is real, this analysis is not investment advice. It is a framework for understanding a structural shift that is unfolding in real time. What you do with that framework is your decision, but the data is clear. The trends are measurable, and the opportunity window is narrowing. Pay attention to what is quiet now, because it will not stay quiet for long.